Hello, and welcome to the second episode of Capital Markets Live. I'm John Gedges, Senior Vice President of Capital Markets at Ginnie Mae, and today I'm joined by David Spector, the President and CEO of PennyMac, a mortgage banking platform that focuses on producing and servicing U.S. mortgage loans, as well as managing investments of U.S. mortgage-related assets. David has been at PennyMac since it was founded in 2008, and now, almost 13 years later, PennyMac is Ginnie Mae's second largest issuer and servicer. In this episode, we'll discuss mortgage forbearance, loss mitigation, and mortgage servicing in this pandemic environment. David, thank you for joining us.
Thanks, John. It's great to be here today, and I'm looking forward to a really fun and interesting conversation.
Great. David, over the past 8 months, legislators, regulators, servicers, and industry groups have been working out the details of implementing forbearance programs to assist borrowers in this pandemic. Can you briefly describe the latest forbearance trends you are experiencing with borrowers of government-insured and guaranteed loans in your servicing portfolio?
Sure. PennyMac Financial's servicing portfolio consists predominantly of government-insured and guaranteed loans. And at the end of October, the total was about 1.2 million loans. On a cumulative basis, we've granted approximately 220,000 customers with government-insured and guaranteed loans a COVID-19 forbearance plan. At the end of October, we had approximately 106,000 of these customers in active forbearance plans. The remaining 114,000 customers have exited forbearance. In terms of how these numbers have been trending, as the pandemic was unfolding and the CARES Act was being implemented in March and April, we saw monthly forbearance enrollment rates of approximately 6 to 8% of our total government-insured and guaranteed portfolio. In recent months, these enrollment rates have decreased significantly to around 0.5% per month in recent periods. In fact, over the last 6 months, the number of customers who've exited the forbearance plan has exceeded new enrollments, and we've seen the pace of customers exiting forbearance increase steadily.
So in the initial 7 months since the CARE Act was implemented, the government-insured and guaranteed loans and forbearance in your portfolio has a net reduction of more than 1/2, and enrollment rates have declined significantly. That's very encouraging for all stakeholders. Are any of the remaining forborne borrowers still making timely payments under forbearance?
Well, John, at the end of October, only around 7% of the total customers in active forbearance plans were current or due for the current month's payment. Keep in mind, however, that we expect the number of customers that are in forbearance currently and making on-time payments to decline going forward as we continue to successfully transition paying customers out of forbearance. In fact, of the total customers that have entered a forbearance plan, about 23% have already exited, either by staying current, reinstating, or refinancing. The remaining customers that are still in forbearance are primarily those that truly need it. And we are working closely with them to find the appropriate forbearance exit solution that will ultimately enable them to restart their payments.
I see. Assuming we don't experience an uptick in forbearance enrollments, loss mitigation activity now becomes the big task at hand. What insights can you share about the percentage of your borrowers that are requesting extensions on their forbearance? And what are the most common types of forbearance exits for borrowers whose loans are in the Ginnie Mae servicing portfolio?
Just to put these numbers in context, for our government-insured and guaranteed loans, about 48% of our customers who have signed up for forbearance did not choose to finish their original forbearance term. For those customers who've reached the end of their original forbearance period, about 74% have requested extensions. Those who don't extend typically fall into one of two categories. The first is the borrowers who can make up their past due payments, and the second is those who cannot. The customers who can afford it elect to make up their past due balance by making a lump sum payment, or they make their past due payments through a repayment plan. For customers who cannot afford to make up the past due payments, we offer a modification deferral, where we place the balance of past due payments on the end of their loan in some form. Or we offer a payment reduction modification, where we work the past due balance and the payment reduction into an overall loan modification. At the end of October, 52% of the customers in predominantly government-insured and guaranteed portfolio who have entered forbearance have exited. About half of those customers have either paid off or become current on their own or through a repayment plan. The other half has utilized one of the modification programs. It's important to note that as a Ginnie Mae servicer, we follow a prescribed sequence and evaluate our customers for these different assistance options as they have been prescribed by FHA, VA, and USDA, who have done a nice job of addressing the unique needs of borrowers who have experienced hardships as a result of COVID-19.
Does Penny Mac maintain a forecast for the expected future volume of loss mitigation outcomes, such as partial claims, modifications, or foreclosures?
Yes, we do. And everything we're seeing is as expected. First, the payment deferral option, where customers can continue making their payments and tack the missed payments onto the end of the loan, is the most popular. It is very streamlined, and we're currently seeing most customers choose this option. In fact, our customers have been selecting the payment deferral option over a modification by about 3-to-1. For those customers that remain in forbearance longer, we expect to see more of the payment reduction modifications in order to help those customers recover from hardship. We are very pleased that the government has come up with such tremendous programs, especially with streamlined solutions for homeowners in distress. As time goes on, we know that some customers won't be able to make their payments at all, and we might need to begin foreclosure activities. However, it is important for homeowners to understand that with the home price appreciation we've seen in recent years, it is likely they have a strong equity position in their homes. Therefore, if they really aren't able to make a reasonable payment, they can consider selling their home for a profit and ultimately avoid foreclosure or a negative credit event.
Roughly 70% of delinquencies in Ginnie Mae's portfolio are FHA-insured loans, and FHA has provided a fresh set of home retention options in response to the pandemic. Would you share how PennyMac works with its customers to determine which type of home retention option is offered to each borrower?
Well, John, again, as a Ginnie Mae servicer, we are responsible for executing the guidance provided by FHA, VA, and USDA. And we've had strong success integrating these processes into our servicing workflows with automation channels that are available to our customers 24 hours a day, 7 days a week. As a matter of fact, around 83% of our customers with government insured or guaranteed loans who have enrolled in a forbearance plan did so online or through interactive voice response. The technology we built for our servicing business is also enhancing our ability to efficiently and effectively work with our customers. As an example, borrowers in forbearance can simply go online and answer a set of proprietary questions that help our servicing associates find the solution best fitted for them. As always, our customer-focused loss mitigation teams are available to talk with customers, learn about their unique circumstances, explain how the programs work, and assist them in determining the best option.
What are the timelines for those loans that are being modified now?
FHA, VA, and USDA all have modification programs that are streamlined, but some require a trial period and some do not. Obviously, the programs that require a 3-month trial payment period take longer to finalize, which is why we generally prefer the no trial period solutions. These no trial solutions have been averaging about 45 days, while the trial solutions can take as long as 140 days.
What threshold metrics does PennyMac try to achieve in terms of a P&I reduction? How does PennyMac set the modified note rate?
We're following the agency guidelines here, which prescribe how to handle offering customers the ability to continue with their existing payments and push their missed payments to the end of their loan term, as well as how to offer reliable payment savings. The guidelines ultimately determine what the modified note rate will be. That being said, customers can go to our website, plug in their information, and get quick answers to those exact questions.
David, our colleagues on the buy side have vivid memories of the high redefault rate of modifications conducted during the global financial crisis more than a decade ago. Naturally, they are concerned that the same outcome occurs. How do you expect modifications of this era to perform?
Given the home appreciation we've seen in the last several years, the customers who are pursuing a partial claim and or modification likely have equity in their homes, unlike during the financial crisis. So borrowers are incentivized to participate in loss mitigation programs, and they are not really redefaulting because they are back on a good path. While it's a little too early to tell on the modification front, our performance rates on FHA partial claims are better than expected. What I can say, though, is that of the government insured and guaranteed loans in our portfolio that were reinstated at the conclusion of their forbearance plans, almost all were current at the end of October.
I see. Ginnie portfolio has approximately 1.1 million loans showing delinquency, representing approximately 10% of the total single-family portfolio. More than one half are in the 90-plus delinquency or foreclosure category. Our buy-side stakeholders, market makers, and certificate holders principally, must deal with the challenges of predicting Ginnie Mae mortgage-backed security prepayments occurring because of massive refinance activity and buyouts of seriously delinquent loans. They are very concerned about the scale of optional buyouts and its effect on their MBS valuations. Could you share with our audience about PennyMac's decision protocol to buyouts? What are the business factors that must be addressed before PennyMac allocates capital to an optional transaction? And why PennyMac has lower buyout rates than your peers?
Well, John, as a leading participant in the Ginnie Mae 2 security, we are very sensitive and cognizant of our prepayment speeds. One of our greatest duties as a top issuer is to conduct ourselves appropriately with respect to refinance and buyout activities. And as such, we maintain a very disciplined approach to refinance and buyouts of delinquent loans. First, let me start off by saying that the ability to buy delinquent loans out of Ginnie Mae pools has been a long-standing feature of Ginnie Mae servicing. The buyout feature allows servicers to manage their advance requirements. Specifically, when a servicer leaves a delinquent loan in a Ginnie Mae security, the amount that we advance is more than the amount that we will be reimbursed. Buying out delinquent loans allows servicers to save costs and manage cash flows. The buyout option is a critical feature of the Ginnie Mae program that ensures a liquid market for Ginnie Mae mortgage servicing rights, especially during adverse economic cycles. Our approach to handling delinquent loans and buyouts starts by mitigating our exposure to delinquencies and default by maintaining a high sensitivity to the credit risk profile of loans that we produce or purchase up front. And on an ongoing basis, we work to keep our portfolio highly performing. Next, as loans go delinquent, we selectively buy them out of the Ginnie Mae MBS pools to the extent that the economic benefit of the buyouts will mitigate the increase in costs associated with delinquencies, including, as I previously mentioned, advancing funds into the security. And finally, doing the work to get the loans to reperform and position them for securitization and redelivery helps us offset other material losses on other loans at default, including VA principal losses, excess servicing costs, and the cost to fund other protective advances, which are embedded losses associated with servicing government loans. As a responsible steward of shareholder capital, PennyMac exercises financial discipline and prudence in how we deploy capital, with careful consideration to our cost of capital. Non-banks have a cost of capital that is materially higher than depository institutions, which have access to deposit funding. As a result, and as a part of our buyout approach, we consider not only the potential pass-through savings, but also the potential redelivery economics. The result is that we end up buying out fewer loans than banks because it is simply not economic for non-banks to buy out certain loans. You can see this in the recent data, which shows that certain banks have had some of the fastest speeds of all Ginnie Mae participants and by a relatively wide. Finally, as compared to other non-banks, our discipline with this activity ensures that our speeds are and will continue to be slower.
David, why are PennyMac's overall prepayment speeds lower than the cohort?
Well, John, as we just spoke about, our slower prepayment speeds have a lot to do with our approach to buyouts. But the other part of it is the discipline we maintain with respect to refinancing our customers. Each time PennyMac engages with a customer on a modification or refinance, we provide the best possible rate for that unique customer. Specifically, when we are refinancing a customer, we provide our customers with rates consistent with market levels. This means that when we look at the refinance eligibility of our portfolio shortly after putting customers in a new loan, we don't see as much opportunity to refinance as compared to our peers because we've already achieved the best possible outcome for those customers on the front end. We believe that this is the responsible approach to refinancing a servicing portfolio. And combined with our discipline with respect to buyouts I mentioned earlier, we expect our speeds to be at the lower end of both banks and non-banks.
What risk does PennyMac attribute to Ginnie Mae's recent APM 20-07, which restricts repooling of optional buyouts to a specific custom pool type?
John, I want to start out by recognizing and commending the Ginnie Mae team for being very thoughtful about the policy decision that resulted in APM 20-07. We believe that Ginnie Mae struck a good balance between managing short-term prepayment speed expectations of existing securities, while also allowing servicers the opportunity to manage their advancing costs, cash flows, and other crisis-related losses. The policy also provides servicers with an opportunity to continue to participate in the buyout program, but it also comes with a few additional risks to manage. The main risks are interest rate risk and the increased hedge costs for servicers. Typically, when a buyout occurs, a servicer assumes some modest level of hedge exposure to account for the time between buyout and redelivery. In the case of APM 20-07, this period is at least 210 days, and thus a much longer holding period comes with increased uncertainty around interest rates. But as the market continues to develop, we expect to see these costs decrease. The good news is that with our industry-leading capital markets and risk management systems, as well as its strong capital and liquidity position, PennyMac has the ability to successfully manage these risks.
David, does PennyMac have capacity constraints? For example, is there a maximum amount of mandatory and optional buyouts you can facilitate each month? Also, what do you see as the cadence for PennyMac's buyouts going forward?
Well, John, as a leading Ginnie Mae servicer, we have significant operating leverage in our servicing business to handle all potential buyouts for a portfolio of our size. Late last year, we completed the development of a proprietary servicing system that has been instrumental in our ability to take existing workflows in our servicing business and scale them for periods of high volumes like we see today without compromising our risk management and compliance practices. Our dedicated team of servicing associates and team members continue to leverage the technology and automation I talked a little bit about earlier, and we are realizing efficiencies as a result. As an example, we are now handling around 7,000 to 8,000 modifications a month, 5,000 to 6,000 of which are partial claims. And to put this into context, pre-COVID, our business was regularly managing around 1,000 modifications a month. From a financial perspective, we don't really have constraints for buyouts, as we have significant investment capacity and financing available, and evidenced by the billions that we've been buying out over the past several months. In terms of buyout cadence, we've been conducting buyouts regularly, and we anticipate this level of activity to continue well into 2021.
What is your expectation for mortgage loan performance as we head into 2021? Should investors be concerned about redefault rates in the coming years? Or is there a reason to be optimistic that redefault rates will be lower this time? And what about foreclosures?
Earlier this year, the whole industry came together to help solve the unprecedented issues we faced. A key byproduct of that collaboration is the borrower assistance programs that were rolled out by FHA, VA, and USDA. They were designed for this unique crisis and were set up to get people back on track in an efficient and streamlined manner by adding the missed payments onto the end of the mortgage and giving meaningful payment reductions where they are necessary. And we think these programs should continue to perform well. The big difference in this crisis, like we have been talking about, is the greater equity position borrowers have in their homes. And we want to encourage homeowners that are not able to resume making payments after their full use of a forbearance period to consider selling their home for profit to ultimately avoid foreclosure.
Well, it looks like that's all the time we have for today. David, thank you for your time and sharing insights about PennyMac's forbearance trends, buyout protocols, and outlook for this era's modification outcomes. These are the pressing issues consuming much of our buy-side's modeling of Ginnie Mae's mortgage-backed security value proposition.
Well, John, I just want to thank you and Ginnie Mae, and it was a real pleasure speaking with you today.
That was David Spector, President and CEO of PennyMac. If you enjoyed this podcast, be sure to subscribe to future episodes of Capital Markets Live on YouTube. If you have any comments or questions about today's episode or other topics, please send us an email at ocmglobalinvestorinquiry@hud.gov. Thanks for listening and stay healthy.